Most IRS problems don't start with an audit or a certified letter. They start years earlier, when a business owner sets up their structure the way their CPA recommended and never revisits it. And that structure works until the IRS applies pressure. I spent years dealing with IRS audits and collections, and I can tell you this: the business structure that looks fine during tax prep often collapses during enforcement. In this video, I'll show you why your current structure may be limiting your leverage with the IRS and why waiting until enforcement begins makes everything harder to fix. The mistake most business owners don't know they're making: most business owners believe structure is about two things: tax efficiency and liability protection. And that's how it's usually sold. Pick the right entity, save on taxes, check the box, move on. But the IRS does not look at structure the way your CPA does. Your CPA looks at structure as a filing framework. The IRS looks at structure as an enforcement framework. A structure can be legal, compliant, properly filed, and still be fragile under scrutiny. The mistake most owners make is assuming that because their structure works at tax time, it will protect them when pressure shows up, and it often doesn't. Here's the key thing to understand: your structure doesn't cause IRS problems, it determines how bad they get. When the IRS pushes, your structure decides how far they can push, how fast they can move, and how much leverage you actually have. And most owners don't find that out until it's too late. Why the IRS treats some structures more aggressively. The IRS is not focused on fairness, they're focused on efficiency. They prioritize cases where enforcement is easier, faster, and cleaner. Certain structures make it easier for the IRS to expand the scope of an audit, attribute business income personally, ignore separation between owner and entity, and reach bank accounts and wages. This has nothing to do with whether your CPA did a good job. It has everything to do with what the IRS can reach and when they decide to act. Clean books matter, yes, but structure determines how much pressure the IRS can apply, even with clean books. That's why two business owners with identical income can have wildly different outcomes under audit or collection. Same income, same deductions, different structure, very different results. This isn't about what your CPA filed, it's about what the IRS can reach. Common structural problems that collapse under pressure. There are patterns I see over and over again. The first is single entities carrying multiple unrelated activities. One LLC doing consulting, real estate, online sales, and side projects all mixed together. On paper it flies. In reality, it tells no coherent story. When the IRS looks at that entity, they don't ask why you chose it, they ask whether it holds up. And when income streams, expenses, and activities don't line up clearly, audits expand. The second issue is commingled finances. Personal expenses paid through the business funds moving freely to personal accounts, no clear boundaries. This doesn't just create bookkeeping problems, it undermines separation. Under pressure, that separation is what protects you. The third problem is undercapitalized entities. Entities that exist on paper but don't look real in practice. No retained earnings, no working capital, no clear purpose beyond tax savings. The IRS doesn't care why you created the structure, they care whether it looks legitimate when challenged. Structures chosen purely for tax savings without durability collapse the fastest. How structure affects audits quietly and quickly. Most audits don't start aggressively, they start narrow. 1 year, one issue, one question. Audits expand when stories stop making sense, and structure plays a huge role in that. When an entity shows repeated losses, reports income that doesn't match activity, claims expenses that don't fit the business, and can't clearly explain its purpose, the IRS starts pulling threads. They don't need fraud, they don't need intent, they need inconsistency. And structure determines whether the audit stays focused or spreads. Audits don't explode because of fraud, they expand because the structure can't explain itself. And once that happens, control starts slipping away. Structure and collections, where the damage becomes real. This is where structure stops being theoretical. Once collections begin, structure determines whether wages can be garnished, whether business accounts are reachable, whether operations get disruptive, whether the IRS can bypass the entity entirely. At this stage, decisions are no longer strategic, they're reactive. And fixing structure after enforcement has started is slower, more expensive, and far more limited. I see this constantly. People want to restructure after levies begin. At that point, options are narrow. Structure is leverage until enforcement starts, then it becomes exposure. Why this is an attorney issue, not a CPA issue? This is where a lot of business owners get confused. CPAs are trained for compliance, reporting, and accuracy. Attorneys are trained for Defense, leverage, containment of risk. Both matter, but not at the same time. When the IRS applies pressure, advocacy matters more than math. This is why people often realize too late that they needed legal strategy, not clean returns. And this is also why changing structure before enforcement matters so much more than after. If you're already receiving IRS letters or you feel like enforcement may be coming, structure stops being academic. We offer a free call to help determine whether your current setup is helping or hurting you before the IRS forces to issue. You can book that using the link below. Why waiting makes this worse, not better. Most owners delay because it hasn't been a problem yet. My CPA said it was fine. I'll deal with it if something happens. The IRS doesn't give credit for intent. They don't care that you meant to fix it later. Once enforcement begins, leverage is already gone. Waiting doesn't preserve options, it quietly removes them. And the longer a structure exists under pressure, the harder it becomes to defend. Business owners often come to believe the worst mistake they made was choosing the wrong structure. In reality, the bigger risk I see is when people stop filing altogether, sometimes for 5, 10, or even 15 years, believing the IRS doesn't really know what's going on. In the next video, I explain what actually happens when you don't file tax returns for years, how the IRS tracks income far more closely than most people realize, and why enforcement changes heading into 2026 are closing the gaps non-filers have relied upon for a long time. If that situation sounds uncomfortably familiar, you'll want to watch that next video.